All right, so this is what we're going to do is chapter 1. We're going to talk about accounting and business. What we're going to deal with is the learning objectives is to explain the purpose and the importance of accounting, right? Identify users and uses of opportunities and opportunities in accounting. Explain why ethics is crucial in accounting, very crucial. And explain generally accepted accounting principles and define and apply several accounting principles. I'm going to start right here by telling you in accounting we use a lot of acronyms. So that generally accepted accounting principles, we call that GAAP. I might give you something out of the workbook on that here soon. So just to give you a little heads up. So what do we do in accounting? In accounting, we identify, we record, and we communicate information, right? We're identifying and recording and communicating information, right? When we identify information, we're trying to identify, is the information what we like to call material? Right? This is the information material. In accounting, material information is information that can influence the decision of a rational investor. It can influence the decision of a rational investor. How many of you have macro? Macro folks. Okay, good. So we should already know when I say rational, it's a loaded term, right? Who's a rational investor?
Warren Buffett.
I don't mean an example, like a definition. Who's a rational investor?
Right.
No, that's another example. I mean defining it. Go ahead.
Someone who weighs risk and reward.
That's good. Someone who weighs risk and reward. That's good.
Considers the opportunity cost. Is the third one.
Considers opportunity cost. Fantastic. Go ahead.
Someone that invests with low risk strategies.
Someone who would invest in low risk strategies, right? And why would they do all these things? Why would they do? Go ahead.
They don't have money.
So, because this is the start of the class, throughout this class, I'm going to say something, and it's called, what would you tell your grandma? And that means bring it down to its lowest common denominator. If you were talking to your grandma, it'd be fantastic. You say, well, you know, grandma, it's going to bring down the risk for opportunity costs. But your grandma might look at you and say, there you go using those college words again, baby. I just love you. Glad we sent you down there to Northern Virginia Community College, Nate. Boy, you. However, what would you really tell your grandma? If you had to tell her who is a rational investor, define rational investor, you would tell her they are what? Go ahead.
A way to invest your money without high chances of losing that money.
That's what you tell your grandma? A way to invest your money. Break it down. Come on down low. Go ahead.
Smart, like educated.
Smart, that's good. Go ahead.
Cautious.
Cautious, maybe you say cautious. Come on now. What would you say? Someone who's rational is what?
Things before I make a decision.
Yeah. How about sane? You're just sane. Right? They're not crazy. Right? They can go in front of a court of law and attest to their sanity. That makes sense? Everything that you've given so far are qualities of a sane person. That makes sense? But in the end, a rational investor is someone that is what? Sane. That makes sense? They've been exposed to all of the public information and they've weighed it in the process of whether they're going to make an investment or not. Everyone with me? I like y'all using these big words on your grandma, but my grandma would be like, what, baby? Say it. They're just saying. They're not riding the short bus. I guess that should go in the video. I don't know. All right. But at any rate, so the first thing, when we're identifying the information, we're trying to see if it's material. If the information is not material, then we call it, and you just saw on the last slide, we call it immaterial. Immaterial information is not information that just gets thrown away. You don't just get rid of information. In accounting, we want to make sure that we are the most informed person in the room, or make a serious attempt to be the most informed person in the room. Therefore, we don't just throw away information. We also don't discourage clients from giving us information. The words that I'm sure many of you have come out of high school learning and using many, many times, or already know that, needs to leave your lexicon in accounting, because it discourages clients from giving you information. Oh, I didn't know that. You're not dismissive. I don't care if the client comes in to tell you that the sky is blue. You treat them like they're Socrates and you're Plato learning the first edicts of the allegory of a cave. You're like, oh, for real? Blue? Really? Is that what's going on outside? Sun. It's up. Daytime. Right? You treat them as if they are the holy grail of information, because you want to keep them giving you information. Because the last thing that an accountant wants to happen is they be caught as the individual with the least amount of information. Everyone with me? It's what you don't know that will get you in accounting. So I always tell students, there's two things that you do with information. Material information gets recorded. Immaterial information gets filed. You just file it for another day. Everyone with me? My mother is a wonderful person. She has paid, much of my family has paid a great bit to educate me. And come tax season, she has come to get her dividends in the form of free tax help. So she comes with her taxes, she comes with her information, and she says, here, baby, here's all the information, do me and your dad's taxes. Now, in there are medical medical expenses. And then amongst those medical expenses are some expenses for very beloved members of our family, Skipper Jack and Goldie. We love them a lot. Well, we love them now, right? When they were puppies, they were Skipper Jack. If you ever had a Jack Russell, it's a bolted engine. So when it was a puppy, it was a little trippy. But now it's all fantastic, right? He's older, he's slowed down. So we love both dogs. However, medical expenses for your dog is not deductible on your taxes. However, when my mother hands me those taxes, she is a paleontologist. She knows nothing about accounting. It's not like, she passed down accounting to me. She's a paleontologist. If you ever have a parent that's a paleontologist, God bless your soul. That means a lot of family road trips where your parent says, stop the car, is that stalactite? Your 4-hour trip to Lynchburg becomes a 20-hour trip, right? But however, right, she hands me the paperwork. I take all the paperwork, and I don't say, hey, Ma, dog medical expenses, they're not counted. Why? Because I don't want her to start saying, well, if dogs aren't counted, I wonder if our medical expenses are That makes sense? And start self-censoring herself. You do not want the client to ever self-censor. That makes sense? Or try to determine it themselves. You want them to constantly tell you the stuff that's going on. So therefore, you do not just say, oh, that's immaterial. You take immaterial information, you file it, and you go for it. Now, so that's the recording process. And then last but not least, you communicate the information, right? Communication is key. This is why in here I say, how would you tell your grandma? Because everyone assumes that each person is on the same level. If you're in business, you're at the top level, you're at the same level. That's not the case. The head of the Vatican Bank is who? Who's the head of the Vatican Bank? The Pope. In the end, it's the Holy Father himself. Are you really about to come into the Pope's office with 300 pages worth of financials and say, here, Pope, here you go. You see, you have a real problem here. Last quarter doesn't look good. You know, you out here, your depreciation's killing you on the Vatican, and, you know, there's other things going on in the financial. Go to the third page, read the notes. You just got a problem. You wouldn't do that to the Holy Father, would you? Make you a bad Catholic. Right? No. And what you would do is communicate to him the way he needs to be communicated. Because he didn't take business classes. He was out helping the poor, giving, like it says in Matthew 25, right? The least of these. He wasn't out here in business school. You were in business school. That's why they've hired you to communicate to them the information on their level, not your level. I see a lot of accountants come in and they're like, well, you know, your intangible assets here, you know, we've gone from makers to, you know, a modification of double declining to get you a different tax basis. And people are like, what the hell are you talking about? You might as well came in and spoke Mandarin to these people. That makes sense? You ever turn on Bloomberg or CNBC and you sat for maybe 1 minute, 2 minutes and was like, what the hell did they just say? Sounds like English words, but however, nothing they said made sense. And that's communication. So you've got to communicate properly to your audience, right? And what are we communicating? We're communicating information that's relevant, right? We're communicating information that's reliable. And we're communicating information that's comparable. Comparable meaning I can take two sets of financials. I can take ExxonMobil's financials and I can take BP's financials. And although they're two companies based in two different countries, because I pull them off of our stock exchanges or SEC Edgar, they will be formatted so I can automatically start comparing them. I'm not going to have to change the monetary unit from British pounds to US dollars to start making the comparison. Everyone with me? They're ready to go. When I pull them down, I can just start comparing. The same thing that Exxon counts as a barrel of oil is the same thing BP counts as a barrel of oil, right? So that's the comparable part. Reliable, we'll talk about in a second, because that goes very much hand in hand with ethics. And relevant information is not only timing, right? It's got to be on time, but it's got to be material, right? You do not want to hear about a company's utility expenses that they paid 20 years ago. Does that make sense? So there's a timing piece when it comes to relevance. There are two types of users that we create financial information for: external users and internal users. External users are users outside of the company. Internal users are people inside the company. External users are people like lenders, bank groups, shareholders, government entities. Internal users are people like the C-suites. When I say C-suites, let me write this down. C-suite. I'm talking about people like the CEO, CFO, CMO, and everything else with a C in front of them. That's the C-suites. Managers, supervisors, staff, the like. All of those make up the internal users of the company. For what we will be doing, we're going to be dealing with external users. External users get what I like to call, what is called financial accounting. And that is what this course is about, financial accounting. When you take accounting 212, we will be dealing with internal information or internal accounting, and we will call that managerial accounting. Managers and internal users get more information than external users. Internal users get more information than external users. Why? Because internal users and external users have different types of information that would change or impact their decision making. Give you an example. If you are an investor, and let's say Five Guys internationally, right? Do you need the overtime report for Five Guys right here in Sterling for last week? If you're an investor in Five Guys internationally, do you need the overtime report for the local Five Guys here in Sterling for last week? No. But you don't want overtime reports. It's too much information. However, if you're the manager of this Five Guys here in Sterling, do you want the overtime report of last week? Yes. Everyone with me? So there's going to be more information in internal users than external users. Opportunities in accounting. There's several different opportunities. These are just listing some of them, right? I would say the major opportunity that's coming in, well, it's already here, is like law enforcement. There are a lot of accountants being hired into law enforcement. There's a pie chart graph of it. Right? Government is expanding with their accountants. Law enforcement, not IRS. That makes sense? The IRS, God bless their souls. Good. You know I'm from the South because I say God bless. God bless your soul or God bless your heart. Right? I guess I can be fired because this is a public school. I can be fired for that. Isn't that crazy? They'd be like, oh, you're trying to push your religion on me. I'm like, what, the South? Is that the religion? The religion of the South? Like, football and sweet tea? Is that the religion? Ethics. Ethics. Remember, this is the cornerstone of reliability, right? Why would you trust information from an unethical person? Everybody with me? No matter what your politics, the honest truth is you don't quite trust the president. I don't care who you are. If some of you are saying, no, you know, I love President Trump. He hasn't been given a chance. Okay, put him in a bedroom with your sister. Let's see how much you still trust him. Nobody would agree to that, right? Right? You put the Pope in, well, maybe you wouldn't. At any rate, the reason you don't trust them because you don't know these people personally, but they've shown you some unethical characteristics. That makes sense? They've lied. And why you wouldn't put Bill Clinton in there either, right? Why? Because they lied. So they've broken this tenet of ethics. Being ethical in fact. Everyone with me? But there's another tenet of ethics, ethical appearance. It is not good enough in accounting to just be factually correct or factually ethical. Just telling the truth does not cut it. You can drive right down here to the bank in a black SUV with tinted windows, pull up to the front, keep the car running, jump out in a black ski mask, a black jumpsuit, and black boots with a black bag and a gun, run up to the teller and say, I just need to make a withdrawal. I'm sorry if we assume you're robbing the place, because it looks like you're trying to rob the place. Now, the fact might be you actually have money in that bank, and you're actually going to pass a slip over and make a withdrawal. But excuse everybody in the county of Loudoun if we hit the deck and start calling the police. Everybody with me? So you could be as factual as you want to be in telling the truth. But if it doesn't look like you're telling the truth, excuse the rest of the world if we treat you like a liar. Everyone with me? So it's ethics. It's not just fact. It's appearance. That, especially this younger generation, you guys, man, you can tell the truth, but man, sometimes you just don't look like you're telling the truth. You know, it's like my daughter. She's like, I'm like, hey, did you eat all that ice cream? She's like, no. But I saw a bowl in your bedroom. Ooh, you got evidence. All right, also when it comes to ethics, right, we try to control fraud from happening, right? When it comes to ethics and when it comes to accounting. And one of the things that we have found is that there are 3 things necessary for fraud to happen. And we call that the fraud triangle, right? And the fraud triangle, the base is opportunity. You have to have the opportunity to do a fraud in order for it to happen. You could want to steal all the gold you want from your job, but if you work at Fort Knox, the chances of you stealing that gold is slim to 0. Everyone with me? So opportunity is the base. Next is rationalization, right? You got to rationalize it, right? You've got to be able to, some people will say, oh, well, I saw my boss use the company car to take his wife out to dinner. That's not company business, so I'll just go ahead and use it too. You with me? So you're rationalizing it. And last is pressure. It's just financial pressure, but just pressure, right? Your bills are behind. This is why you get credit checks. They're looking to see if you have pressure. If your credit is down, your bills are behind, right? You're late on your car note, you're late on your house note. That will create pressure for you to begin to rationalize a fraud. Everyone with me? Good. Sarbanes-Oxley, this is just a slide. We're going to talk about this more in a later chapter. But Sarbanes-Oxley was passed by Congress. We're going to talk about 2 laws, Sarbanes-Oxley or SOX. And these are just some of the companies and what they did. You can see that in a later day. And Dodd-Frank is our banking and consumer protection law that was created. Sarbanes-Oxley was created to reform accounting. This was to reform banking, right? Put it into too big to fail. Do you guys know what too big to fail is? Go ahead.
In 2008, the auto companies were too big to fail.
Okay.
Meaning they had so much money.
What made them so too big?
Meaning they employed so many people and they had so much money that if they went under, it would be worse off for the economy.
Right. The company is so big that the ripple effects of firing that company would be worse than just saving them. or bailing them out. That make sense? This is actually an after effect of Enron. Protect the taxpayer by ending bailouts and protect consumers from abusive financial services. All right. Let's see. Moving right along. This is GAAP, generally accepted accounting principles. Now we're getting to the nuts and bolts of what we do. GAAP is, in financial accounting, it governs our concepts and rules, right? And it aims to make sure that the information is the three things that we had just said: relevant, reliable, comparable. Right? So it's a set of rules and regulations. These are overlapping. These are big rules. They're not, don't think specific rules. I'll give you guys a second to write that down. So, in the United States, our oversight, our government oversight agency, is the Securities and Exchange Commission, or the SEC. Make sure I write that up. SEC. Right. They have authority over establishing the reporting requirements and set GAAP for companies. The other oversight group we have is the Financial Accounting Standards Board, right? And the PCAOB, Public Company Accounting Oversight Board. And that's for U.S. In the U.S., we have U.S. GAAP. Internationally, there's some international standards, International Accounting Standards Board, right? And they issue the international standards. Right? In the U.S., we do U.S. GAAP. Internationally, they do international accounting. And some of you would say, well, what's the major difference? I would say that the major difference is our origins, right? Where we come from. International accounting is mainly its origins are mainly for government agencies, and those government agencies are trying to do what? What do they want out of the accounting information? Go ahead. What's the government always want? Yeah, we call that what? Taxes. Yeah, they want to make sure they're taxing correctly. Everyone with me? They're getting their share of the money. And then in U.S. accounting, financial, the private sector, right, created it, right? Financial institutions. What they're trying to do is just evaluate if an investment is a good investment or not. Everyone with me? So you'll see a more conservative tone and a more conservative number in U.S. accounting than in international accounting. That makes sense? And sometimes you'll hear critics of U.S. accounting say, well, we should do certain things that the international community does. They're doing that because they're trying to help their governments be better at, getting better estimate of what taxes they should collect from the companies. So they're allowing companies to over-exaggerate how much or how much, you know, an asset is, because they can just tax that asset. That makes sense? So that's the major difference, although we've tried to converge them, but it hasn't worked out, right? International standards in today's global economy, there is increased demand, right, by external users for comparability and accounting reports, meaning international standards and U.S. standards come closer together. This demand arises when companies wish to raise money from lenders in two different companies. So what is happening is, if you want to raise money on the U.S. Stock Exchange and the London Stock Exchange, you've got to not only do your, well, not London, but let's say the DAX, which is Germany. You not only have to use the U.S. standards, but you have to use the international standards. So companies sometimes don't like to do two different standards. That's where the convergence was coming around, because they wanted us to, if everybody was on one standard, then they could just make one set of books. But it didn't work out, right? So the ISB, they have what's called International Financial Reporting Standards, which is IFRS. The differences between U.S. GAAP and IFRS are decreasing, right, as we pursue convergence. But it has not occurred. Going back to GAAP, as I said, there are general principles. These are basic assumptions, concepts, and guidelines for preparing the financial statements. General principles stem from long-used accounting practices or corruption in accounting. Okay. Every now and then, you know, no accountant in the history of accounting has ever stolen money. If you were to go to the AICPA, trying to give you as many acronyms as I can. American Institute of Certified Public Accountants. Say, my accountant stole money from me. Somebody might faint. So no accountant has ever stolen. You know what they've done? They've misappropriated funds. There's been a lot of misappropriation in the field of accounting. Make sure you understand, no accountant has ever stolen a dime from any of you. You like my voice, guys? No one. Makes you feel authoritative, right? That's appearance, folks. Appearance. See how I wrap that in? Wrap that back around. That's appearance. Specific principles are detailed rules used in reporting business transactions and events. All right. Specific principles arise more often from the rulings of authoritative groups, right, and not in GAAP. So here are the principles and some of the basic principles and assumptions that we use with GAAP. First, measurement principle. I like to call this the cost principle. So the cost principle is basically, we put things on the books at cost, at the actual cost. Right? So if you make a deal with your father, your generous father who might have a tract of land out here on 7, and he gives you $1 million tract of land for $1, you say, thank you, Daddy. You're the most wonderful dad I've ever had. Right? That might be a little creepy. Right? You give him $1, and you put it, let's say you put it in your company. You got to put it on the books as what? $1. Even though it's worth $1 million, you got to put it on as $1. You will actualize the actual $1 million once you sell the company. And then if you sell it for, once you sell the property. If you sell the property, let's say you sell it for $1 million, you'll have $999,999 in profit. Good luck on those taxes. It's good money. Revenue recognition. Revenue recognition gives us guidance on when a company must recognize revenue. We will discuss that more in depth as we go on. we're going to talk about the two bases of accounting, cash and accrual. And that is going to dictate when we recognize revenue, not only just revenue, but expense recognition, when we recognize our expenses. Expense recognition, or the matching principle, now this one I like to call the matching principle, prescribes that a company must record its expenses incurred to generate the revenue. So we try our best in accounting to put the revenue that was generated from, the expenses that were generated from a revenue in the same time period. Everybody with me? So we're trying to put them in the same time period. This will make more sense in chapters 3 and 4. Full disclosure principle is a wonderful principle. It is the principle that all material information must be disclosed on the financials. So you got a little international company going on, and you're down in Nigeria, and you decide to pay the government to shoot the people because you're tired of them protesting outside your oil well, got to put it in the notes that you're a killer. Yeah, I like it because it's just that companies do so much stuff. They're very, and companies today in the world are just achieving feats, and they're just in brilliance that we haven't seen in mankind ever, in the history of man. And so it's really nice to look in the notes at some of the things that these companies are actually doing. That makes sense? Like some of the new things, maybe in R&D, or different things that they're doing, or stuff that they have done. That makes sense? Now some of it is pretty atrocious and you don't want to hear about it, right? But some of it is great. And then it's always great to hear how they write it up, because they can even make a killing sound great. Well, we have redirected resources to the governmental agencies to help us manage people expressing their First Amendment rights. Isn't that wonderful? Isn't that so great? You're like, oh, that is nice. Did y'all get them? Y'all get them sweet tea? Throats were parched while they protested. tea. All right. Little top off over here. Okay, buddy. Glad you hate us. All right, on the other side we have assumptions, right? There's certain assumptions that we make. One assumption is going concern consumption. That is that the company will not only be in existence in a year. We assume, and some of you are going to be like, this is simple. We assume that a company will not only be here in a year, like in existence, but it'll be also doing the same thing that is doing today in a year. Right? And some of you might be like, what? Like, I know for you, you're like, well, Tesla's selling cars today. They're probably going to be selling cars next year. You're right. But, let's see. Apple computers, right? They made the shift to iPods. And maybe some of you were very young when this happened, but the first iPod was nothing but a transition from a Walkman. So you had a company that went from computers to Walkmans. It doesn't quite sound like the same thing, right? When you say iPads to iPods, not iPads to iPods. When you say like MacBooks to iPods, it sounds close. But when you say MacBooks to Walkmans, you think of the 80s, and Stranger Things on Netflix. You're like, what? Pac-Man? Everybody with me so far? So companies, sometimes they'll innovate, but they'll innovate themselves into a new field or genre. So when we look at companies, we assume that they're going to be doing the same thing that they're doing next year, but sometimes they take a shift. Everyone with me? So you have to pay attention to that. Monetary assumption. We assume that the financials, right, are expressed transactions in money, right? Now, some of you are saying, duh. Right? Why would we have to write that down? Oh, my dear sweet scholars. Because there is an accountant that decided to make sure that those transactions were in dollars. They put them in cows. They've taken financials and changed them out of US dollars to pesos and didn't tell anyone. So when the exchange rate, somewhere historically, the exchange rate was like 1,000 pesos to a dollar, or 100 pesos to a dollar. So they changed their little $100,000 profit to a $10 million profit. Made them look brilliant because no one knew they were writing them up in pesos. Until somebody came to look for the money and they were like, this looks like $100,000. They're like, yeah, but it's 10 million pesos. You know how your friend said something to you, and you know that they think they said something brilliant because they got that look. They're like, they point to it. You're like, what the? You're an idiot. We're going to jail for this, right? Yeah. Time period assumption is that we can break down the financials in any types of time periods, whether it be daily, monthly, weekly, quarterly, what have you. You can take the financials and break them up into periods of time. Business entity assumption is that the individual and the business are two separate entities. They're not the same entity. God, we have that in U.S. because it definitely helps the entrepreneurial spirit, right? People can, so for instance, if you went down here to McDonald's and you burnt your tongue on some coffee, right? You cannot sue the CEO of McDonald's personally for you burning your tongue. You can sue McDonald's, that makes sense, but you can't sue the CEO personally. He can't lose his personal effects like his house and his car because you burnt your tongue. That makes sense? Now, you can sue McDonald's and McDonald's has to pay you, but not the CEO personally. Everybody with me? So, all right. There are different types of business entities, right? We have sole proprietorships, we have partnerships, we have corporations, and within these, there are certain subcategories too. And just some of the attributes of these companies, right? For only sole proprietorships and corporations, right, can have one owner. Sole proprietorships are the most common company. Everyone with me? In business, we count you as a sole proprietorship if you are one, in a profit pursuing venture, and two, you have not organized it to be in one of the other categories. That makes sense? So if you're pursuing profit, you have not organized, you're a sole proprietorship. Businesses is taxed. Only corporations get taxed directly. Liability, limited liability, meaning they can't sue you for your personal effects. It's corporations. All of them are business entities. Only corporations are legal entities, and only corporations have unlimited life. All right. Now this is what y'all came here for, right? We're going to start down the rabbit hole of accounting, right? So we'll start with the accounting equation. This is the simple accounting equation. Assets equals liabilities and equity. When dealing with this accounting equation, we want to make sure that it always stays in balance. How do we keep it in balance? You can do one of two things. You can do, where's my, anybody see my marker?
Behind the laptop.
Thank you. Thank you. You can do an equal transaction on both sides of the equation. And now keep it equal. Or you can do an equal but opposite transaction on one side of the equation. So you can add 500 and minus 500. Everybody with me? And that will keep your equation in balance. But your equation has to always, scholars, be in balance. Now, next two slides, definitely the first slide, not the next, all three, need to be written down. You will see it in the next three chapters, the very same slides. So please take time now to write it, so that way you don't have to write it in the future, right? So assets are cash, accounts receivable, notes receivable, land, vehicles, supplies, buildings, equipment. These are resources controlled and owned by the company. Go ahead.
What do you mean by accounts receivable?
Accounts receivable. Accounts receivable is when you lend credit to a customer. So they've come and got product or a service from you, but they have not paid you yet. So I like to term it as you have not received the money. Right? It's accounts receivable.
Pages of credit.
So, right, so you said, hey, I'm gonna give you product and you can pay me back in 30 days.
That's
Go ahead.
accounts receivable.
Accounts receivable.
Wouldn't that be like you going to get like Invisalign and orthodontist or something like that?
Yeah, if you don't pay right there, then
If
it's
you're paying
accounts
like a
receivable.
monthly installment.
Right, then it's accounts receivable.
What about notes receivable?
Notes receivable, fantastic. So accounts receivable are short term. They're under a year. A notes receivable is when someone owes you, but they normally owe you more than a year. The payments are more than a year. Fantastic
It's
question.
the same thing, just different time.
Time periods. You'll see the same thing in liabilities in a second. But when you see accounts receivable, think short term. When you see notes receivable, think long term. You are the first class that ever asked those questions. Any questions on these slides? That's impressive.
Also, is the PowerPoint gonna be on the Blackboard and this
Yeah. Right now, the old PowerPoint is up, which has a couple of these slides. It definitely has this slide, but it doesn't have all these slides. I'm going to change it and put this one up.
Would you recommend also taking over that one though?
Not bad. Whichever works.
Where on Blackboard is it gonna be?
PowerPoint. It's under PowerPoint. It's a good question.
I'm not used to Blackboard.
Don't nullify that question. It's under PowerPoint. All right, so the next thing are liabilities, right? Liabilities are things like accounts payable, notes payable, taxes payable, and wages payable. Payables, remember I said on receivables, you've lent out credit, but you have not received the cash. Now, with a payable, someone has lent you credit, and you have not paid the cash. That's normally how a lot of you, some of you, will have a problem with receivables and payables. So that's how I normally differentiate. Receivable, you have not received cash, and a payable, you have not paid cash. So normally with an employer, you work 2 weeks and then 2 weeks later or a week later, they pay you. That makes sense? There's very few jobs in our current economy in which you work and get paid. I mean, I guess you say Uber and a couple of people, but I mean, most people who are working a regular 9 to 5, you work 2 weeks or work a month and then you get paid 2 weeks later, a week later. So when that happens, because a payable happens when you legally owe money. You legally owe the money, that's when it's a payable. So when that person works a day, you might not pay them. Let's say you pay people on the 31st for work. Because there's a timing thing that is going on here. So let's say on the August calendar, right, someone works from the 1st to the 15th, they get paid on the 31st. Everyone with me so far? You work from the 1st to the 15th, you get paid on the 31st. They can only work on the 1st and leave. And guess what? You owe them for 1 day of work on the 31st. So for that 1 day they've worked, you are legally liable to pay them on the 31st. You don't pay them by the 31st, they can go to court and have a judgment put on you. Everybody with me? So a payable, you are legally liable to pay, but you know. So every day company works, individual works, the company is accruing a liability. Go ahead.
Are there non-legal liabilities in a company? So just like things that you're responsible for that are for your business that like you can put down for accounting, but they're not legally, they're just.
Not legally binding?
Yeah.
Well, okay, so a liability is you owing money.
Yes.
So let's say, for instance, like a court. You might have a pending court case going on. Someone sued. Let's say, for instance, for a technology breach, and you might not know the outcome of the breach. You may put on there, well, and you'll definitely note it in the notes, but you may say, at this point in the legal process, we're figuring that our liability will not exceed $50,000. The minute you put a monetary amount on it, the minute you say it's not going to exceed $50,000, you need to put that in the books. That makes sense? But that is an example of it could go up. You never put it at the amount that, at the higher, you don't overestimate there, you always underestimate it.
Okay.
Makes sense? Or most companies, they overestimate. Does that answer your question? Is that what you're thinking?
I think I'm just like thinking of something different. It's.
Oh, okay. Any other questions? Let me give you the next one. Oh, that clock is wrong. That's giving y'all false hope. It's actually 12:02. My bad. I don't mean to snatch that away, but I didn't want you to get to like 110 and be like, we're out of here. Like, no, it's 107. You're still here. I know you saw it on your cell phone, but you picked it up. I'm just messing with you. Some of you are like, what? He caught me. Equity. Equity is, these are synonyms. So I just put it capital N or common stock. For the beginning of this class, we're just going to be calling common stock capital N because it's an investment, capital investment. Capital out or dividends, right? And retained earnings. So here is the long equation. And this is the equation that we will mostly use in this class. When I teach you the debits and credits, because I'm sort of teaching you it now, but I just haven't revealed everything. I'm going to say assets equal liabilities plus contributed capital, capital N or common stock, minus the dividends, or capital out, plus revenue minus expenses. Revenue minus expenses equals what? See, huh? Profit. Fantastic. Profit. Good. Profit, we'll be calling that net income because we're in accounting. We use the word net income. But profit is fine because that's what you've been introduced in business class. So, let me say it again. No, I'm serious because I just stood back up. Assets equals liabilities plus contributed capital minus dividends plus revenue minus expenses. Go ahead, question. Okay. Because all of this, let's see here, contributed capital minus dividends plus revenue minus expenses equals equity.
So assets are after taxes.
Huh?
Assets are, because in liabilities, you're paying taxes.
Mm-hmm.
So assets is everything you have after taxes, meaning when you get, I'm asking a lot.
Yeah, so the tax liability piece is really somewhere else. So don't
Okay.
think about that. When you think about taxes, don't think about your asset.
Okay.
That has no effect. We'll be dealing with taxes and when we're dealing with income statements, and then on this side of the ledger, it'll only be at liabilities. Taxes payable. Questions? We're going to stop here. On Thursday,